Hello and welcome back. Now in this lesson we will look at the capital allowances. Capital allowances are simply depreciation as far as taxation is concerned. Now you know from your earlier studies of accounting, you have been studying accounting for years and years, I assume. So you know from accounting that you take the asset and you deduct something out of it which is called depreciation. So when you're using the asset is gradually reducing in the value. So that thing is called depreciation as far as accounting is concerned. There might be some different definitions that you have studied at different accounting papers. So we are not talking about accounting depreciation. Here at this paper, we are only talking about taxation depreciation. So when we talk about taxation, whether it is F6 or P6, when we take the assets, we have to reduce its value. How can we reduce its value? We cannot deduct depreciation. However, we can deduct capital allowances. All right. So you know that when we make the trading profits, so we take the accounting profits and we make some adjustment in them. So we add something into it, then we deduct something out of it, so that it is usable for our taxable purposes. So that is called tax adjusted profit. Now, as you know that when we are making the trading profit, we added something called depreciation as well. So we added depreciation back to the profit. But however, we have deducted capital allowances out of it. So that is called capital allowances, what we have to deduct. Although we are adding back accounting depreciation, but we have to deduct the taxable or tax depreciation. So in accounting, it is called depreciation. In taxation, it is called capital allowances, right? Now, in your accounting studies, you know from your accounting studies that how to calculate the depreciation. I'm not expecting you to know each and every bit, but if you could remember, there were few methods of calculating depreciation. Could you remember? One of them was called straight line depreciation. Could you remember it, please? A straight line. There was another as well, if you remember. Which one was the other one? Reducing balance method, was it? So there was straight line method and there was a reducing balance method as well. You might well know there is another method as well, which is sum of digits method, but it is no longer allowed by accounting standards, so we do not consider it anyway. However, our topic is not accounting because it is taxation class, so you will study accounting in other exams. As far as this capital depreciation is concerned, tax depreciation is concerned, it is called capital allowances, and there is only one way in which we can calculate the depreciation. It is reducing balance method. Now, could you remember from your earlier studies how to calculate the reducing balance method depreciation? So we take the asset value, we deduct depreciation out of it, so the net value will be reduced value of the asset. Then in the next year, we will calculate the depreciation on that reduced value. All right. So that is why it is called a reduced balance method. So because we are calculating the depreciation each year on the reduced balance instead of the straight line, which is the value which was first bought, which was the value when the asset was first bought. In a straight line, we we take the depreciation on the straight value each and every year. There is just one value. However, as far as reducing balance method is concerned, we take the reduced balance every next year. So we'll take the depreciation, and the next year the balance will be reduced, and so on and so on. All right. So in capital allowances, we'll take the reduced balance of depreciation. Now, if you could please move to your notes, I'm going to share the screen with you. Here you go. I've already shared the screen with you. Now, you might see on my screen the chapter name is Capital Allowances. Now, if you are watching this lecture for P6, that's fine. You are watching for P6. Please make sure you download the notes, and it is page 33 on your notes as far as the P6 is concerned. So it is page 33 on the P6 notes. Now, if you're watching for F6, this topic is also relevant to F6. If you're watching it for F6, then please make sure you download the lecture notes, and your page will be 23. Page 23 on your lecture notes is of capital allowances. All right. So please make sure, although I've shared the screen, but it might be a different number in your notes. So please make sure you download the lecture notes, but it will be exactly, the material will be exactly the same. So you do not need to worry about it. So the concepts are exactly the same. I've already shared the screen. Now I'm again saying, please make sure you download the notes, even if you are watching it for F6 or P6. It is page number 33 in P6 notes, and it is page number 23 in F6. All right. Having said that, let's move and read from the screen. So here you go. It says capital allowances. Now first one, it says writing down allowance. Now writing down allowance. What is writing down allowance? Now I have made the different sections here on the board. My screen will be a little smaller, so you might not be able to see now. But if you rewind the video, you can see in the start. You can see there are different sections. All right. So these I have already made the sections. Now we will do a question in the next lecture. Then you will understand these better. But first we need to look at the concepts. So first one, it says on the notes, writing down allowance. Now writing down allowance is a method of calculating the depreciation. So how can we do it? It says there, a writing down allowance or written down allowance of 18% on reducing balance is given on the plant and machinery in each accounting period in the main pool. So there will be different pools when we will be calculating the depreciation of taxation. So when we will be calculating the capital allowances, there will be different pools. So there will be one will be a main pool, it could be special rate pool, and blah blah blah. So there will be different pools, and it is talking about main pool. So as far as writing down allowance is concerned, 18% depreciation will be calculated on reducing balance method. Excuse me. Is given on plant and machinery in each accounting period in the main pool. Right? Then it says if the period is less than 12 months, then we will have to multiply by months over 12. So it could be less than 12 months, and even if it is more than 12 months, then still we need to increase this percentage. So this 18% is for 1 year, it's for only 12 months. So if your accounting period is more than 12 months or less than 12 months, then we'll have to adjust this 18% according to the months in the accounting period. I hope at this level now you can do it. Then it says full writing down allowance, full WDA is given in the year of purchase and no writing down allowance in the year of sales. So when you buy the asset, full writing allowance will be given in the year of purchase, whereas no writing allowance will be given in the year of sales. We will see when we do the question, but for now these are just the rules. The next one in the list is annual investment allowance. Now annual investment allowance is also one sort of depreciation which will be calculated on in the capital allowances. Right? So annual investment allowance, what is that? So like the name, it says annual investment allowance, so it means it will be given annually. Businesses can claim, it says, an annual investment allowance of first £500,000 spent on plant and machinery. So first 500,000 spent in a business will be annual investment allowance. Right? Annual investment allowance is £500,000 multiplied by months, so 12 if the accounting period is more or less than 12 months. So again, if the accounting period is more or less than 12 months, then we'll have to adjust, because this £500,000 limit is only for 12 months. After calculating annual investment allowance on the plant and machinery purchased, a writing allowance is also given on such plant and machinery. So whatever we have calculated the first annual investment allowance, so after calculating the annual investment allowance, then if still the value of asset is still left, then we will give the writing down allowance as well. So we will calculate two depreciation. If first of all we will calculate annual investment allowance, which is on first £500,000, then if the value is still left, then we will take it to the main pool. And what is the rate in the main pool? You have already read 18%. Then again 18% will also be given. So there will be two depreciation given. Now in accounting, depreciation reduces the value of asset, all right, which might be not good when it goes to the balance sheet. Whereas if we talk about the taxation, depreciation is favorable. Depreciation is good for us, because the more the capital allowance is, less tax we will have to pay. I hope you would appreciate the fact this, because final figure from this capital allowance will be deducted out of the trading profit. So when it will be deducted out of the trading profit, our trading profit will be reduced and we will have to pay less tax. We will have to pay tax on the reduced profits. All right. So as far as capital allowances are concerned, they are very, very good for us in the taxation, unlike accounting depreciation. Then it says full writing down allowance is given in the year of, sorry, I was on the annual investment allowance. So it says if it is more than or less than 12 months, then we'll have to adjust like that. After calculating annual investment allowance, writing down allowance is also given on such plant and machinery. Now then it says annual investment allowance cannot be claimed on cars. So if there are any cars, you purchase some cars, there won't be any annual investment allowance on the purchase of cars. So it is only on the purchase of plant and machinery. Right? After that, there is something called first year allowance. Now the first year allowance, as you can see, it says in the name. So first year allowance is 100% available on the cars with low emission of 75 grams or less than that. So I told you we've already seen benefits in employment income. So in employment income, we will have to pay more tax if our car is less environment friendly. So like that in here as well. So if your car is 75 grams or per kilometer or less CO2 emissions, then you will get 100% first year allowance. Now 100% first year allowance, what is this? Although its name is allowance here, all of them are allowances. So allowances simply means capital allowance, right? So it is type of capital allowance. When it says first year 100%, first year allowance of 100% is available on purchase of cars with low emissions. Say for example, you have purchased a car which costed you £10,000 and which was 75 grams or less than that, then whole £10,000 will be capital allowance under the section of first year allowance. So 100% of that. Then it says first year allowance is not reduced or increased like WDA and AIA. Now, like writing down allowance or annual investment allowance, what we used to do there, that if the accounting period is less than or more than 12 months, then we would have to adjust our allowances. Whereas in this one, first year allowance, it is a standard rate and we will not adjust it. Like it says, first year allowance is not reduced or increased pro rata like WG and AIA if accounting period is short or longer than 12 months. Right? Now after that, it is a special rate pool. Now special rate pool is another pool, and we will calculate the capital allowance in a special way in this one. Now expenditure, it says expenditure on thermal insulation, solar panels, long life assets, feature integral to a building, and cars with CO2 emission of 130 grams or over than that are included in the special rate pool, not main pool. I told you there are different pools. So first pool was called main pool. So what exemption, what allowance do we get in that? 18%. Whereas in special rate pool we get 8% instead of 18%. And what will go into the special rate pool? It has already told you: solar panels, thermal insulation, long life assets, feature integral to the building, cars, and blah blah blah. Now thermal insulation, you know that what is it? Just to check the temperature. Solar panels, you know that. Long life assets, what is long life assets? Now please check beneath that there is a note called long life assets. Now this is the list of assets which are called long life assets. Now before the list of assets which are given beneath that, there is a note given: these are assets, long life assets are the assets which have working life of 25 years or more than that, and which cost more than £100,000. Alright, so these are the long life assets. Whereas if you talk about the integral features of the building, and the list is also given to you for the integral features. Now integral features are simply the things which are very, very necessary to live in a building, like lighting in here, heating, cold water, something like that. All right. So here's the list: electric and heating system, cold water system, space and water heating system, power system of ventilation, power system of cooling and air conditioning, and lifts and escalators. So these are very, very important things. That's why these are called integral features of the building. So these will all go into the special rate pool, as we said. All right. So that was part of integral feature, and these are called, and these will go into the special rate pool. Right. Now, if you come to page 34, please, where it says plant and machinery with private use. Now, some of the assets might be used in the business as well as privately. So, if any asset is used privately, there are two kinds of private use. One is private use by an employee. Say, for example, if I am an employee of AccountancyTube, if I use something for private use, that is not private use, is it? Because it is not private use by the boss. It is not private use of the owner. It is private use of the employee. So private use of employee is an expense. Whereas if you look from the boss perspective, private use of boss is a private use, right? So let's see in the notes. If there is a private use of the plant and machinery by the proprietor, by the owner, not employee, then capital allowances is calculated on the full cost, but only business proportion of capital allowances can be claimed in order to deduct it from trading profits. All right. So just to explain again, that if there is private use by the boss of the business, then it will be considered as private use. When it is private use of the employee, then it will not be considered as private use, because it is not his own business. So even if he's using it for private use, it will be expense. Whereas if we talk about the owner of the business, if he takes something for private use, if he uses something for private use, that will be considered a private use. All right. And in the note it says in the brackets, not applicable for companies. Now could you please tell me the logic behind it, not applicable for companies? Now say for example, who are owners of the company? Could you please tell me who are the owners of the company? Are directors the owners of the company? No, directors are employees of the company. They are just working for the company. Who are the owners then? Yeah, you're right. Shareholders. Shareholders are the owners of the company. But if you think practically, shareholders are not working in the company, are they? They just bought the shares and they are sleeping at home. So who is responsible? Who is managing the company? Directors are managing the company, and directors are responsible for management of the company. Now, if the directors are responsible for the management of the company, so they may use stuff privately. Now, they are employees. Even if they use privately, it will not be considered anyway. But who are the owners? Who is the boss? Shareholders. Shareholders won't use anything privately anyway, because they won't be in the business, they won't be in the office. So that's why it is not applicable for companies. It is only applicable for sole traders. Right? Now in the end it says note. Now in the note you can see that such assets must be kept separate from other plant and machinery in calculation. So these assets will have separate section, separate column of these. After that it says balancing allowance or balancing charge. Now when you sell an asset after using some time, say for example if you have bought an asset and you used it for a year, obviously that asset would have been depreciated. Now after using 1 year, you have then sold it. Now we'll have to see the market value when you sold it. Now we will check the market value. Now if you have sold more than market value, you made a profit, so that will be chargeable to tax. If you sold less than market value, then you incurred a loss and you won't pay any tax. You will get the relief instead. Alright, so that's what it says in the notes, balancing allowance or balancing charge. Now balancing charge is simply a profit. When you sell an asset and you made a profit, it will be chargeable to tax. That's why it is called balancing charge. Whereas the other thing is balancing allowance. So balancing allowance will be given when you incur a loss, so that will be deducted out of your profit, so you will pay less tax. On sale of plant and machinery, profit, and in the bracket it says balancing charge, or loss, balancing allowance will be calculated. When an item of plant and machinery is sold, then for calculation purposes the sale proceeds are taken as lower of sales proceeds than original cost. You know from your earlier studies anyway, from accounting studies. So when you sell an asset, you will take lower of sale proceeds than original cost. Normally profits which are balancing charge or loss, balancing allowance, will not be calculated for the sale for the sale of the assets in the pool, unless the assets in the pool are sold when business ceases. So it won't be calculated unless the business is going to cease. Alright, so that's what it says normally happens. So we normally do not calculate the a balancing charge or balancing allowance unless it says in the question that business is going to cease. All right? If the business is going to cease, then we will definitely going to do that. Then it says capital allowances on the cars. Now, what are the capital allowances on the cars? Now, there are different types of car, I told you. So there could be a car which is environment friendly. If there could be a car which is not environment friendly. So here's the list. So cars emitting 75 grams or less, which are low emission cars, which are environment friendly cars, will go into the first year allowance, and they will be 100% first year allowance will be available. So we'll have to pay no tax on these because you will get 100% first year allowance. Cars between 76 grams to 130 grams is added into the main pool. Now, what was the main pool? What was the rate? 18%. Yeah, so 18% allowance will be given in the main rate pool. Cars emitting between 130 grams, cars emitting, it says between, it's not between, it's over, just over. Cars emitting over 130 grams is added to the special rate pool. And what was the rate in the special rate pool? What is the rate of the allowance? Yeah, you're right, 8% is the rate in the special rate pool. Alright? Then it says if there is a private use of the car by the proprietor, not employee, then capital allowance is calculated on full cost, but only business proportion of the capital allowance can be claimed in order to deduct it from the trading profit, not applicable for companies. It is the same thing which we have seen earlier, so it is nothing changed. And then in the note it says such assets must be kept separate. We already know it anyway. No annual investment allowance is given in the cars. So if you buy any car, there won't be any annual investment allowance, right? So that is it. And just beneath that there is an example. So we will see the example in next lecture. So that is it for our capital allowances. Now, if you could, although we've finished our capital allowances as far as our lecture is concerned, but this is the example. Now, if you could, before I wind up, if you could please check this one here on the board. It says different sections. Now, I've already written these sections for the comprehensive example, which we will do in the next lecture. So, first year allowance, FYA, then it is annual investment allowance, main pool, special rate pool, then it says laptop, 10% private use. Now, if you know if the owner or the proprietor is using an asset for private use, then we cannot put them in any of these sections. We will have to keep them separate, it says in the notes. So that's why I kept it separate. Now, if there is any other asset, this is the car. So this was used privately as well. So that's why I kept it separate as well. So this was 10% private use, this was 20% private use. So I cannot make them in the same section because the percentage of private use is different. So likewise, if there would be another asset, say for example 25% private use, then I would have put into the next section. So there will be, all of them will be kept separate as far as private use is concerned. So this section here, capital allowances, this is the amount, whatever we are getting from each of them, we will keep putting in here, and then we will make the total of capital allowance. This is the amount, this is the total which will go into the trading profit, will be deducted out of that, and we will have to pay less tax. So that's why I was saying that capital allowances are good as far as taxation is concerned, because it reduces our profit and we'll have to pay some less tax. Right? So that is it for this lecture, and I will see you in the next lecture with a comprehensive example of capital allowances. And before you follow me in the next lecture, please make sure you check the notes and try to attempt the question before you watch me on the next lecture. All right, please try to attempt it. Then you can see me in the next lecture. How where did you went wrong, if so. Right? Thank you very much, and goodbye.